Welcome to Real Estate Explained, the podcast that gives you a backstage pass to the ever-evolving world of real estate. I'm your host, Nick Bush, a realtor with over a decade of experience helping clients buy, sell, and invest with confidence. Whether you're a first-time home buyer, a seasoned investor, or just curious about the market, this show is for you. Each week, we'll dive into trending topics, break down the latest real estate news, and bring you expert interviews with the pros so you're prepared for every step of the journey. Ready to turn your real estate goals into reality? Keep watching. Now I'm just looking at him.
That's how I feel about my Travis. I'm like, man, them giant steak.
I'm just looking at him like, whatever, Because Eric, is fresh. He's suit, got the pocket square. He do it up. He does it up. So I was like, let me at least throw a polo on.
Listen, I appreciate it. I appreciate it. You know what I'm saying? And I was looking and I was like, man, I ain't trying to really overstep.
No.
You know what I'm saying? I didn't want to come in here with a suit, so I just had to settle for a little suit jacket and some jeans. So.
No, I knew. I said, he coming in here, he going to put it together. Yeah, so I said, let me just throw a polo on so I look like I belong in the room.
I appreciate
Bronson, are we recording?
Yeah, we're live.
All right, so I had to get a little dressed because you always do that. I knew it too because I remember we were smoking cigars that day, and they asked you about your. I think you were going to propose, and I think somebody said like, "What you going to do to that?" And all you responded was, "You said always step." I said, "Oh,
if you see me, I'm a step. Like that's one thing for sure, two things for certain. I'm a step.
He gonna step. So that's good. Thanks for coming on the pod, bro.
Of course, bro.
We live right now.
I appreciate it. I appreciate you having me, man. I see you doing a lot of dope work.
Thank you.
Appreciate you reaching out and just jumped out the opportunity to connect and get on here, bro.
Thank you, bro. Before we and your name is really good out in the streets too. So
okay, good.
So that's awesome. Before we get in, before we press record, Eric, you live out in Baltimore.
I do.
And so you said something like Baltimore, the DMV area, and I was like, Baltimore's not the DMV. So before we jump into that,
let's unpack that because what's the beef? What's the true beef between Baltimore not being in the DMV and it it's kind of being on its own island? What's the backstory on that?
So first, introduce yourself to the people.
All right.
And then we're gonna go back.
All right, cool. So for those who don't know me, I'm Eric Davis, Senior Mortgage Advisor at Mission Mortgage. I've been in the business almost a decade now. Had the honor and privilege of serving close to about 500 families. With a focus on helping first-time homebuyers build, as well as investors. So that's kind of my thing, man.
Okay. Welcome to the pod. Let's get into this topic.
Let's get it.
All right. So there's a lot of people trying to co-opt this DMV thing.
Okay.
A lot of other cities, right?
Okay. Yeah.
I even saw that Pharrell one time try to say that Virginia Beach, because he's from the Virginia Beach area, is a part of the DMV. It is not.
Okay.
It is not. It's not even close, bro.
All right.
Baltimore is definitely not part of the DMV. Baltimore is its own island.
Okay.
Right? Even the people in Baltimore, they don't feel like they're from the DMV. Maybe if you ask a 21-year-old person, they might feel like that, but they have no education.
Okay.
They have no knowledge.
Okay.
Nobody that's 30, like a millennial, 30, 40, thinks that Baltimore is the DMV. So to my knowledge, so if you think about it, right, Baltimore they have their own little slang, everybody, like the DMV, we kind of all talk the same, use the same lingo, same slang. It's the same vibe, dress the same. Baltimore has its whole own situation. There's nobody in the DMV talking about yo said. This word demi that's like Baltimore only. They're their own island.
Okay.
To my knowledge, also Baltimore and DC had like a beef for a long time, like some street beef. But I think that's just because whatever. So the DMV this is the DMV, like. DC, obviously, first of all, people need to really understand, the DMV is very territorial.
Okay.
Right?
All right,
educate us. I grew up in Northern Virginia.
Okay.
I never tell people I'm from DC.
Okay.
If I go out of town, I'm like, they're like, where you from? I'm like, Virginia. I would never say DC. Just because there's just a territorial thing happening.
You feel like you'll be false flagging?
Yeah, I'm false flagging. I'm not from DC.
Okay.
Right. I'm not from DC. Right. You're from the Bronx. It might as well be Manhattan.
No.
I'm not no. I'm not from DC.
Gotcha.
What I'm saying is you would never just be like, I'm from Manhattan. I'm from Brooklyn. No. You're from the Bronx. So it's like that, right?
Yeah.
People in DC, they have a lot of pride. And mostly they don't like people in Virginia. They're like, oh, Virginia's corny, you know what I mean? Because they don't like the police from back in the day,
gotcha.
Right? So that's the issue. So you got the Virginia side. The DMV part of Virginia, for real, goes I would say up to Woodbridge.
Okay.
Is the original all right, that's the DMV. Now it's extended a little bit out to like Stafford, right?
Okay.
And then if you go west, it's really like McLean, Sterling area should end it, but now it's built up. So now it's like Ashburn, Gainesville, where Bronson lives. Bro, like I didn't know what Gainesville was like when I was growing up. That was like the country. Warrenton was the country.
I remember.
Ashburn
I
was
did
the
I did a
country.
loan for somebody in Gainesville. I'm like, wait, is this in Florida? I'm like, you sure this not Florida? They're like,
Yeah.
nah, it's VA. I'm like, all right.
Like Loudoun County was not the DMV when I grew up. Like Loudoun County is not the DMV. Then PG County is obviously the DMV. A lot of people from DC go live there. And then Montgomery County. So I would say if I'm going counties, I'm going PG County, Montgomery County in Maryland.
Okay.
Right? It's the only DMV counties.
Okay.
In Virginia, it's like Arlington, Alexandria, Fairfax County.
Okay.
And then you got DC.
Okay.
And that's the DMV. Now it has extended out to like Loudoun County. Oh, and then like Loudoun County, some of Prince William County, but that's like new DMV.
Okay.
You know what I mean?
All
But
right.
Baltimore is definitely, we don't associate with them like that.
Listen, I get it. I feel like it might be it might be kind of on the same lines of like how people from New York look at when people talk about the boroughs, right?
Yeah. Like y'all don't include like Staten Island, right?
You're not really from the city. Yeah.
Exactly. So Grace, I want a clean clip of this where I'm telling you where the DMV is, right? So I'm doing it again. If it's already in there, don't edit it out. I'm talking to Grace. So we got PG County, Montgomery County, Fairfax County, Alexandria, Arlington, which kind of have their own counties, and DC is the original DMV. Now it's extended to Loudoun County and Prince William County, and nothing else is the DMV.
Okay.
There it is.
All right.
Yeah. So why doesn't New York respect Staten Island and Yonkers and like all those places? 'Cause people coming out of there. Like,
I
Long
mean,
Island.
no, people come out of there, but it's kind of like isolated on its own. You know what I'm
Yeah.
saying? Whereas like when you're in the city, right? It's you kind of just think about New York City. You think about Manhattan, the Bronx, Brooklyn, Queens. And then kind of Staten Island is like the afterthought. You know what I'm saying? So I guess that's why when you was kind of breaking it down, I'm like, all right, well, maybe they look at Baltimore kind of how we would look at like a Staten Island.
We don't even consider Baltimore.
All
the
right,
DMV
so
conversation,
it's
right?
not even it's not even a cousin. It's just not even okay.
It might as well be. I associate Baltimore actually more with Philly. They like more like Philly people.
Okay.
But anyways, we can talk about that all day. So you say you niche down with first-time home buyers and investors. Mm-hmm. So how did you end up like niching down in that space? With first-time home buyers.
Yeah. So I think naturally you get into business, right? Most of your clientele when you first kind of start cutting your teeth is going to be first-time home buyers, right?
Yeah.
Those are people that's transacting more, right? People are more inclined with programs, et cetera. So I always had a passion for first-time home buyers, right? I actually got into the business because I experienced my family not have the best experience when they purchase. So first-time home buyers is always going to be near and dear.
Yeah.
But more I got into the business, I realized like, all right, it just don't stop here, right? Like if I could do it right and I can educate and empower these first-time home buyers to not only look at this as a purchase for shelter, right, but look at this as an investment, which it is, right, then I can kind of set them up for the next step, right?
Okay.
Because, I tell people all the time, Monopoly is not a game, that's real life.
Yeah.
You know what I'm saying? So like if you could apply the principles from Monopoly to life, that's how you really win a game.
Yeah.
Like you don't just work to make as much money as you can but never own anything, because the more money you make, if you're not owning anything, it's more money that's going out.
Yeah.
You know what I'm saying? So as I started to grow in my business and grow with my clientele, it just naturally just started gravitating to more investors, and also me being an investor, I just kind of use the opportunity like, yo, listen, do this, right? Kind of look at this from like a 2 to 3 year window standpoint, and then let's revisit and then start building, as far as like the investment side. So that's kind of how I got into those two niches.
So I feel like that's interesting, right? Because when I first got into the business, I was doing a lot of first-time homebuyer stuff. Mm-hmm. I was 26, so it was just natural that I was, working with first-time homebuyers. Mm-hmm. That was my network. And at that time, I was doing a lot of VHDA, DC Open Doors, FHA, but I think I was telling people, I was like promoting those programs all the time. And now when someone, is trying to buy a house, they're like, hey, how much money do I need down? I'm like, you need 6%, right?
That's
I'm like, 3% for down payment, because you can go, conventional, home ready, whatever, that's or FHA 3.5. And I'm like, you need to have 3% for closing costs, just so we can be out in the market and have the most, the most leverage, right? But then I say there are programs where you can bring no money down or 1%, and then we can get your closing costs taken care of by the seller. So you leave those as options, but I tell everyone they should be ready with 6%. And I feel like my first time homebuyer client is different now than it was back in the day, right? It was like a lot of 620, 640 credit score, barely making it, right? Like, are we going to get through underwriting? Now it's like a 700 credit score person who makes 100,000 and has just been renting for a while. Did you deal with that? Like, do you have?
I think it's similar, right? Like when I first got in the game, I kind of made my name in the business by being able to take on hard deals and make hard deals loan. You know what I'm saying? They're like, oh, a lender say can do this. I'm like, all right, well, let me take a look at it, right? So you start to figure out, but then as you go in your business, you're like, all right, it's more than this type of business, right? But I think the evolution that we've seen in regards to like the qualifications and how qualified people are now is simply just, the generation shifts, right? Like millennials are now, everybody's in their 30s for the most part, right? So like we were one of the most educated, right? So along with education, knowledge, like more, higher earnings, right? Higher paying jobs. So all of that just kind of shifts, so the credit scores rise. So I think that's kind of why you're seeing a shift in the business. I just think overall we just more qualified, more educated, better paid.
I think millennials, we have the information, right? So I remember growing up, if I asked my mom, like, how much money do you make? She'd be like, don't ask me no question like that. It's disrespectful, right? But I'm probably going to initiate that conversation with my kids. I might not tell them this how much money I make, but they're going to learn about money. And I'm like, this is how much money's coming in. This is what this costs, saying the structure. I have a 14-year-old, and when he's going into 9th grade, and when he gets to junior year, 16, it's like, here's Rich Dad, Poor Dad. Figure out who you want to be. Here's the richest man in Babylon, so you could like get an understanding, a foundation of like budget yourself, right? And I think millennials, we have the I graduated high school in 2008, so that was the recession, right? Like we went to college, and they were like, yeah, we don't know if you're gonna get jobs when you come out, but you should go to college anyway, right? I think millennials are very entrepreneurial, but like we know we know the game and we study it, so we understand. Oh, you got to invest. You need a good credit score, right? You should rent. You should own versus rent. Like we just kind of have that knowledge, and I think a lot of people are taking advantage of that. I have clients. So how receptive are people to the investing conversation? Because I have clients. I have probably like 4 or 5 people in my database, and I tell Bronson this every time I'm here. I'm like, Bronson, you need to be buying a bunch of houses. You need to buy a condo or buy a townhouse, live in it for a year and a day. As long as you make a lateral move or a move up, you can do that, right? Like, and just like buy 10 houses and do that 10 times, right? Is that how you're approaching the conversation?
That's 1,000%, right?
Okay.
1,000%. But I also think because I'm a little biased, right? Because I'm a millennial as well. But I feel like we're the best generation because we're stuck between 2 major like generations, right? Like we seen the working class, right? Like our parents, they work, they like, go to school, get a good education, work hard, right? But then we stuck right between everything being technology, like, you know what I'm saying? The evolution of how technology is moving. So we're like, all right, we see the work. So we got that work ethic, but we also see how fast technology can accelerate, right? So we can combine the two to really supercharge this thing, right? So I think that's why, in my opinion, as a generation, we're so far off better than most. But to circle back on the investment approach and coaching that I kind of advise clients on, that's exactly what it is, right? I tell people, if your goal is to build wealth, right, and really create a solid financial foundation, buy properties and buy as much as you can, because
Yeah.
everything that's written in America, from tax code, everything is always for people that own things, right? That's pouring into the economy,
Yeah.
right? So it's like it's more expensive to start a business, right, and buy a business or get a business loan than it is to buy a house. Like, yo, just save up your money or you leverage your retirement. Like
Yeah.
that's another thing. Like, if we ain't learned nothing, like the last couple months with how retirements has been fluctuating, man, pimp that retirement out. Because what people fail to realize is where the money comes from, how money gets to a consumer as far as buying a house, right? The banks get the money from, Fannie, Freddie, Ginnie, right? That's getting the money from investors, right? These are the same investors that's in the stock market, that's then taking their money out of the stock market, putting it in mortgage-backed securities, you know what I'm saying, and to be able to fund that, right? Where they're getting that money is your retirement, your 401ks, you know what I'm saying? Like the things you're investing in. So it's like, it's always baffling to me when I talk to people and they're like, oh, I don't want to dip in my 401k. That's like my long plan. I'm like, no, you missing it. Buying a house, this is your retirement right here. You know what I'm saying? If anything goes sideways, you have an asset you could leverage. You could sell it, you know what I'm saying? You can refinance, pull the money out. So
And you need a ton of money in your 401k to really live comfortably in retirement. Like if you have $1 million in your 401k, it's going to translate to $40,000 a year in 20, 30 years, and you're going to be broke being working a job that you don't want to work. So you really need like $3, $4, $5 million in your 401k for it to be worthwhile. Instead, you can just buy real estate that cash flows, right? So something I'm looking at is like markets, like Baltimore is this market, right, where you could find something for $100,000 or less and cash flow $700, $800, or you can find another type of property for $200,000 and still create some cash flow by putting that 20% down and stack those on top of each other. Obviously I'm biased because I'm a real estate agent, but I'm like, I could take $100,000 and turn that into thousands of dollars of cash flow, or I could put that in the market and, you get 7% is great if you put in the stock market, but one is going to improve your life faster and it's going to compound faster and you're going to be able to use it. Like I look at it like, okay, I'm buying income. If I know, okay, well, I need to put 20% down on this $100,000 investment property, it's going to cash flow me $700. Well, $20,000 buys me $700 of income, today. And then, in 20, 30 years when that's paid off, that might end up being $2,000, $3,000. We have our property in DC, and I always say, like, if I'm netting $20,000 a month, like I feel like I could do whatever I want. Like that's that's like enough. Like I'm doing whatever I want, right? And so we have our property in DC that we bought with our primary FHA 3.5% down. We now rent it out. It rents out like $3,200. So we're getting a little bit of cash flow. We can increase the rent if we want to. But I'm like, okay, that's $3,200 right there. Maybe in 20 years it goes to $4,000 in a perfect scenario. That's our first $4,000 of income in retirement, and that's how I look at it too. And I don't know why. And also like the 401k the Social Security is gone. 401k, I don't know if it's gonna be there, and so it doesn't feel safe to me.
Yeah, none of it. I think we gotta get out of this false security of like retirement or the things that we deem to be safe, right? It's false. It's a false reality, right? Like, I think I read a statistic. By the time like we're eligible for Social Security, it might be used up. Right. So it's like you planning or you banking on that kind of being your fallback. That's not even guaranteed to be there, right? Whereas like if you could just be mindful of the opportunities you have now, right? Leverage your retirement, save some money. And then, I'll tell people, if you want to get into investing, you don't got to jump out and do 20% right off the back, right? If you do it smart and you just, like how you said, right? You buy your first property.
So like teach people how do you navigate that?
So I always tell, and I'll share one of my best client testimonies. So you could easily do like buy your first property using FHA, right? If you're fortunate to get like a multi-unit, then you golden, right? So you put 3.5% down on that property, you occupy it for 6 months to a year, right? then you can change your primary residence, go buy another one, right, and put 5% down, right? Then you put a tenant in place to offset your mortgage on the first property, right? Now you have your first investment.
Yeah.
And there's no rules to say you can't change your primary residence every year.
Yeah.
So you can, if you do it the right way, which I have a client, she bought her first property she bought in Baltimore near the Oriole Stadium, like over there by Pigtown, right? She bought this house for like $120K, like I want to say maybe like 6-7 years ago. She wasn't making a lot of money. She was making under like $40K a year. She bought it, all right? It's now in an investment property. She rented out on Airbnb. We were working the numbers for another property she was trying to buy last year. She's making like 40 grand profit.
Yeah.
From a house that she bought $120,000 like 6 years ago.
That's great. That's your $1 million in your 401k, right? Yeah.
Right. Like what we talking about? So we put together a plan, and like from the first time she bought that one, over the next 5 years, she just bought another property. Mm-hmm. She just made it primary, right? Living in for a year, put a lease in place.
Yeah.
Now she got 5 cribs.
Yeah.
She good. If she don't do nothing else,
she's already a millionaire.
She golden.
Chilling. Yeah.
Golden.
Exactly.
Golden.
It's really the wave. I think that so how do you prepare for somebody for that conversation the first time is that like after they close, you're like, hey, by the way?
No, I think like for me, I'm real transparent, right? And I like to think I do a really good job at like planting seeds. Like I love to be able to plant a seed and have somebody think about something in a different perspective. Yeah. You get what I'm saying? Because I think it's so easy, especially with like TikTok and all these influencers popping up now, right? I think it's so easy for people to hop on these platforms, follow all these people, and then take what they say for gold. And I'm like, this person don't even own anything, right? Like this person all of this is written. Like this car, like this lifestyle, this is not even true, right? So I love to just be able to start like chipping away and just building and helping reshape the mindset, because that's really all it is. Is like once you change how you look at something, how you look at things change, right? It changes your perception, right? And perception is reality. You know what I'm saying? So it's like when I'm doing my consultation on clients, I like to have an understanding of, all right, well, how much or how little you know about the process, right? Like, are you the first person in your family buying? Like, have you experienced seeing other people purchase, right? Because that tells a lot, right? Like if me having a conversation with someone that they come from a family full of homeowners, they privy to some knowledge. They know a little bit. You get what I'm saying? Yeah. So they already have a mindset like, yeah, I'm looking at it as far as an investment, right? Or if their parents invested, they already kind of got that in their mind, where if you're dealing with like a first generational like homeowner, they don't know anything, right? Yeah. So they're like, I just keep hearing that this is what I'm supposed to do, and I'm doing well. I just want to buy something.
I've had that conversation a ton. I think I should buy a house,
Yeah.
So I want to, we talked yesterday. You had that move up buyer, bridge loan product. I want to talk about that, but let's get the evergreen content out the way also, since you do work with first time home buyers. Yeah. So just so people know, what do first time home buyers need to know? What documents do they have to have prepared?
Sure.
What kind of position do they need to be in, credit score wise, et cetera?
Yeah. So I would say credit score wise, right, 640 or above, right, if you're looking to really give yourself some options. Now, that's not to say that if you have anything below a 640, right, we can service clients at 580. But I always tell clients it's like a seesaw, right? You either got to have assets or you have to have the credit. Yeah. So if you don't have the credit, right, then you have to have more assets. Yeah. So it's kind of like, we can help you, but you got to be able to help yourself too. Yeah. Where 640, most of the programs, that's kind of where they start, right? Most of the down payment assistance, closing cost assistance programs, they require you to at least have a 640. So I would say 640, right, if you're looking for a goal. As far as, the time, I always tell people, the moment you know that you want to buy, just start at least getting a plan together. Yeah. Because too often, I see clients wait until they're like 30 or 60 days out from their lease being up, and then now they're trying to undo 20 and 30 years of bad money behavior. Yeah. while racing against the clock, that's what makes the process so stressful, right? I think that the difference between someone having a good experience, of course, working with the right team, right, being advised properly, having a plan, is giving yourself time.
Yeah.
A lot of times people, they overestimate like how much time they have, right? And underestimate how much stuff they really need to work on.
Yeah.
You know what I'm saying? So it's kind of like, the moment you know you want to buy, just have a conversation. It don't cost you anything, right? Because you can have a conversation with me and I can say, all right, well, based off of where your profile is today, this is what you qualify for, right? If you don't like that number, then I can say, all right, well, either pay this down or once you get a promotion or, once you get your certificate, you make more income, then it can push you to afford a house like this, right? So that this way you have a plan and you're able to work the plan.
Yeah.
As far as documentation, we normally just look at the basics, right? So W-2s, if you're a W-2 earner, pay stubs, bank statements. Normally the only time we look at like tax returns is if you have a business, right? Okay. You're self-employed, or if you have rental properties that we're trying to use the income from. So those are normally times we pull like tax returns.
Yeah, trust the lender that tells you like the real information that, hey, you should get a 640. I've sit down with lenders sometime and they're like, we got a 580 product. I'm like, sure, but the person has to bring 20%. Mm-hmm. And so I'm glad that you're giving them the real information. And I always tell people like 6 months out at the latest, like 6 months out at the latest, because it gives you like a quarter to like figure out what you need to do, if you need to do anything. And then you have a few more months to like shop once you get qualified. And then I also tell people, whether they have 800 credit scores or 600 credit scores, I always say I would never do any business if I didn't know loans, because nobody cares about the home inspection contingency, right? Mm-hmm. And people, sometimes people with the lower credit scores, they're nervous to do an application because they feel like they're going to get denied. And they're like, well, I have this credit card that I need to pay off, or I'm planning to pay my car off. And I'm like, yeah, you can do all of those things. That's probably great. But you should actually talk to the lender to make sure that those are the right things to do. Because 100%. You could be spending money somewhere where you don't have to spend the money, or we should spend it somewhere better. Mm-hmm. And instead of, you and me, the realtor and the client, running a hypothetical situation, I'm like, let's just ask the person that's going to give you the money.
1,000%. right.
So let's talk to the lender. So I think you guys are really valuable. What do you think? Do you think that for the average person, having the realtor like talking to a realtor is better than talking to the lender first, or lender then realtor?
If you think about it, right, the show really don't start until you talk to the lender.
Yeah.
But I think because the average consumer associate buying a house with a realtor, right, because y'all are on the forefront, y'all showing properties, right, y'all negotiating. I like to think about the realtor being like the quarterback of a team, right? Yeah. Everybody knows the quarterback, right? But it really don't start until you talk to a lender. So, I think it all, regardless if they talk to you or talk to me first, they still got to talk to me before you could even show them anything. Yeah. So, I think more times than none now, we're having people to reach out to us directly, right? I think, people are getting more educated on like how the process works. Yeah. So you have people even reaching out to lenders before they even talk to agents, right? Just to say, hey, I just want to see where I am. I just want to understand what my options are before I even talk to an agent or start looking.
Selfishly, I want to say the realtor, because I would hate for the business to be flipped upside down and I have to get referrals from you and take you to lunch and coffee, right? Yeah. But you're right. The show doesn't start until you talk to the lender. And I think the main benefit of having that conversation with the realtor first is because a good realtor is going to understand the loan options and credit scores and debt to income ratio. We're going to be able to talk about that a little bit. And then we vetted like lenders already. So you want to have a good experience both ways. So I think it's like have the initial conversation with the realtor so you can talk about like a little bit about loans and about the market, what you're going to buy, where you're going to buy, what that might cost.
I think that's a good assessment because again, y'all are in the trenches, y'all are in the streets more, so y'all know like if a question comes up about areas, right, or new development that's coming on. Y'all have more knowledge and can speak to that.
Yeah.
So I'll agree with you.
But every
on that.
home buying seminar I've ever done, I look at the lender beforehand. I'm like, no one's here to hear me talk, right? Like they're here for you, bro.
1000%.
They do not care about the appraisal. They want to know how to buy a house with nobody down.
That's a fact.
So in my database right now, I have a lot of move-up buyers. Move-up buyers, someone who owns their house, and most people are moving up to a bigger spot because they have, kids now, or they just want more space, or they're like, okay, we need the school district. It's kind of like, I would say a move-up buyer is someone who's, pretty much getting in their forever home, right? That 10, 15, 20-year home, and they're going to raise their family. Now, I leverage the rent back scenario all the time.
Okay, good to go.
All right. So we have an awesome buy before you sell product, right?
Okay.
Because, if you're paying attention, there's a lot of people strapped for cash, right?
Yeah.
So even if you own homes, a lot of times you can't really make a move until you sell your home because you need to access the equity in there to be able to put down a down payment or pay for your closing costs on the next one. So we got access to a buy before you sell program, right? Which will allow the client to tap up to 85% of the equity in their home.
That was great.
Right? And the way it works is you list your property, right? Normally, the program will allow you to tap up to the equity before any contracts are drawn up, right? Once you close, the proceeds that you get from the sale of your property, you just pay off the bridge, if you would.
Okay.
But the cool part is, when you think about traditional bridge loans, a lot of times they required you to carry both mortgages.
Yeah.
So you had to qualify for both mortgages, which again is another pain point for people. With this product, you don't have to.
Okay.
Yeah.
Are there any fees associated with the
Yeah.
product?
So there's no money on the equity that you're leveraging. It's just a percentage of what you have to pay back on once you sell a house.
Okay.
Which is 2.4%.
Oh, that's not bad.
Yeah.
So 2%. I have clients that want to move up, but they have to sell first.
Yeah.
And the rent back seems a little bit risky.
Yeah.
They're like, are we going to find a house because the inventory is so low? That's something like that is very useful. I think people just need to get more information, man, instead of just
1,000%.
planning themselves. There's what can I do? Because there's so many products and different products, and people don't decide to go get the information.
Yeah, I think that's kind of what handicaps a lot of people is just the lack of knowledge and the lack of vulnerability of saying, hey, I'm raising my hand, I need help, right? I want to understand this better, right? I think we do a terrible job at faking it till you make it, if you would.
Yeah.
Everybody wants to always feel like they have stuff, in order, put together, but it's this is what we do every day, right? There's changes in the business happening every day. Lean on us for that advice, right? Lean on us for, the guidance, because that's what we're here for.
Yeah.
But I think especially over the next 5 years, there's going to be a huge wealth transfer.
Oh, elaborate on that. What do you mean?
think, so you got to think about it, right? The biggest players or the biggest owners when it comes to home ownership are the boomers, right? So it's what happens once they start passing away or they want to start downsizing or offloading stuff? There's more inventory that's going to be on the market, right? So I would say, and this is advice that I'm giving to all my friends and people that are close to me, is just figure out ways for you to just keep grabbing properties, no matter how big or small, right? If it's a $100,000 home, $2,000, right? If you making your primary an investment and you're going to buy another primary, just keep buying until you can't, right?
Yeah.
Because eventually home ownership, we're kind of seeing it now, it's getting to a point where it's getting really expensive. You know what I'm saying? That's why we see the average homeowner age
30.
It's
It's 38.
Yeah,
now.
you know what I'm saying?
But some of that, also, sorry to cut you off, some of that is baby boomers buying their downsizers.
Okay.
Their house. So I noticed, I remember a couple years ago it was 33, and I was like, that's reasonable. And then I saw that it was 38, and I was like, why is this happening? I was like, oh, because the baby boomers are also
downsizing.
But it's interesting because they do say, and then the other part of that is somebody listening to this would be like, well, we're talking about the average age of first-time home buyers. And it is a little interesting because I know you become a first-time home buyer after 3 years of not owning a home. And technically a baby boomer might be already. They probably are downsizing and buying another home. So maybe it is for real 38. I just had that whole thought in my head. But 38 is crazy when you think about it, right? Like that's late in the game to buy a house. I think that like you should get out of college. I mean, that first house you buy should be the one you frat house, you know, the group home.
I mean, I think if we set our family up right, the first home should be when they're in college, like you said. Like, you know what I'm saying? Yeah. Like you figure like the parent can go on the loan, right? Put the child as the primary borrower, right? Yeah. The primary owner. And then they can fund everything. They can use their assets, their credits to buy it, and then allow their kid to be able to get some passive income. Yeah, right. Rent it to his boys. Yeah, you know, get some passive income, and then once he gets out of school, 4 years of builder equity. Now, you know, he got a little bit of money. He can, you know, figure out what he want to do, right? Thing. So I think that would be the best and most smartest way to get going. And then, you know, once you get out, depending on your job and location, you can just start buying your new primary.
So I know rates have been, you know, 6.5% for 2 years now, 3 years now. And so I think the interest rate conversation is a little old and stale. It's just like it is what it is. But I know that people still want them to go to 5 and are hopeful, and the market's going to go crazy when they go there. And maybe they won't stay at 7 forever. But are people still... Have people accepted that as the new normal, or just kind of business as usual?
Yeah, I mean, I think people since February, mortgage applications has been up. Right? Okay. So I think people are just facing the fact, like, you know, regardless of what your political views are, this is who's in office, right? This is the administration, right? This is where rates are, right? We understand that everything is high. This is what it is. So I think people are just accepting that fact. And then we also have an overwhelming amount of pent-up demand. So like the people that miss the opportunity to buy a home in 2021 and 2022, all they did over the years was stack money, right? Yeah. Improve their financial situation. So like people are like busting out the seams. They have to make a move now, you know? And that's why I think once rates drop, even by like 1%, it's going to be crazy. Yeah. It's going to be crazy because of the amount of pent-up demand when you add into where we are as far as like housing formation, right? Like as a generation, all the millennials are now in their 30s. This is when people start getting serious about buying homes. I think when you add all those factors into it, you know, the end of, because I believe closer to the end of 25 is when we'll start seeing some relief. It won't be crazy, but 2026, I think it's going to be crazy.
We've been waiting for a long time, man. So I have an idea for a real estate take. I'm gonna record about you know, Grant Cardone and Robert Kiyosaki keep saying that your primary residence isn't an asset. I think it's a ridiculous take. But what do you think about that? Do you feel like your primary residence is an asset or a liability?
I think it depends on how you use it, right? Like, so when I first bought my first crib, bought it as a primary, a house hacked. Yeah. I made it an investment immediately, right? So it was an asset, right? And it allowed me to cover my mortgage at the time. And I wasn't making, you know, a lot of money at the time, but I was able to save all that money because all my living expenses was covered. So I think everything is about perspective. You know what I'm saying? Like, because even if you buy a home as your primary and it's not cash flowing you right now, but you're buying in a neighborhood where you know the equity is going rally. I mean, you're just investing in something, you know what I'm saying, for the later, right? So I think it's just all how you look at it.
Yeah, I have two clients that I did CMAs for last week, and they're both up. One is up 22%, and they bought in 2021. Okay. One is up 22%. The other one's up 29%, and if they sold today after, you know, realtor compensation, fees, closing costs, etc., they'd both walk away with $70,000 in like 4 years. And I'm like, so why is this thing not an asset, right? Like, where are you getting $70,000 in 4 years? You know?
Yeah, you got to think about it too. Like, people don't even get. I mean, most people don't even get like a 3% raise every year.
Exactly.
You know what I'm saying? You talking about you buying an asset and it, at the minimum it's going to appreciate like 3 to 4%.
And you put 3% down. They both put 3% down when they bought. So they bought both of those people bought, you know, a $300,000 and a $320,000 house, and it's like, all right, so you brought $9,000 to the deal, right? and you're up 70,000. Like where is that happening? So I feel like it's
Crypto, that's it.
Crypto,
Yeah, that's
I'm on the crypto wave right
Same.
now. I thought to myself, I said, I'm buying a lot of XRP right now.
Same.
And I'm like, man, I'm not buying enough Bitcoin. I need this is the granddaddy. All right, before I get you out of here, man, what is some actionable advice that you can give to home buyers and home sellers right now?
I would say talk to, people that's in the industry, talk to the professionals, talk to real estate agents, talk like yourself, talk to financial advisors or mortgage advisors like myself, right? See where you are, understand your numbers, right? Because I think, again, regardless if you own one or you don't own any at this time, the opportunity for you to really position yourself and your family and really transcend your wealth over the next 5-10 years is here.
Yeah.
So if you're not being proactive with understanding where your numbers are and like what's possible, what's capable for you, you're gonna get left in the dust. So I'll say just have a conversation, see where you are, right? If you own, figure out how you can, leverage a product like the buy before you sell, right? Or leverage a HELOC and to be able to buy, even if you love your primary, you don't want to move, figure out how you can leverage the equity to go get something else because you can never own enough properties. You can never own enough.
You can never own enough. John Hope Bryant had 700 trying to get like him.
So listen, he
700, yeah.
Yeah, the crazy thing is when I first got it, sidebar, when I first got into business, I did a deal, and I think this was the seed that kind of changed how I looked at real estate and really bought into the investment side of it. I had a client, and he was an older gentleman. He's probably in his 70s, but he owned over 40 properties.
Yeah.
Throughout Baltimore, right? And every time somebody in his family achieved a milestone, he gave them a property.
Oh, that's cool.
That's okay, cool, you got married, here's a property, right?
Yeah.
It's rented out, you could keep it, take the cash flow, or you could sell it and then take whatever, if that's 90, 100,000 as a down payment and just do something else, right?
Yeah.
I think a lot of people talk about generational wealth and considering their last name right before they sell, that's how you change generations. You know what I'm saying? Be able to hoard and accumulate a lot of properties, have other people pay them down, and then be able to put your people in position to win.
I'm totally on board with the buy your first house in college thing. And I've seen, and I'm sure you have, I've just seen so many people who are like, oh yeah, my parents are gonna give me a gift to buy, and they give them 20% down. And I'm like, what a gift. Oh, you're just gonna get 80,000 right now? And I almost feel like it's my responsibility to be able to do that,
1,000%.
And it's not hard to do. You could do it with 3% down, 5% down, and just accumulate over time. Keep them, hold them, make sure your numbers are solid. And all the investors, there's people out here doing that for real. And so I think some people think that it's just not in their bandwidth, right? But it's actually pretty easy if you create a plan and make it happen. So
1,000%.
yeah, and Bronson, Grant Cardone has 12,000 doors. So that dude's crushing.
Crazy.
All right, man. Thanks for joining me, bro.
Of course, man.
I hope you don't have to go right back to Baltimore 3-hour drive.
No. I'm gonna shoot over to the office in DC.
Okay.
Work out of there for
okay. How can the people find you? Get in contact with you?
They can find me on social IG. At Eric C. Davis, simple, right? And no tricks, just Eric C. Davis. If they want to connect with me via email, just eric@mymissionloans.com. Phone number 410-240-8226.
Boom.
Whatever you could, whatever I could do to help, I'm here.
Boom, and don't be shouting out the DMV if you're out in Baltimore, man.
I'll be sure.
Don't be shouting out. He thinks he's in the DMV. He's not though.